Hi, I'm Michael Canavay with Silverlight Asset Management, and I'm here to summarize for you the 3 things you should know about Donald Trump's tax plan. Last week, the Trump team released a one-page, 250-word memo outlining his tax plan. There are 3 key elements you should know about the current state of the plan. 1. It's a long road to passing actual legislation. 2. Stocks may have already discounted this news. And 3. A crucial element of tax reform is the interest rate deduction policy. Let's review these issues one at a time, starting with the tax reform process. The memo is a first step on a long journey. Throughout this month, Trump officials will hold listening sessions with members of Congress to develop details of a plan that can pass both chambers. The 1980s, the time of cassette tapes and Pac-Man. Here's a picture of Donald Trump about 30 years ago, shaking hands with President Reagan. This is around the last time the country completed major tax reform. During the Reagan era, tax legislation was first proposed in 1982 by Bill Bradley and Dick Gephardt. Reagan didn't seriously take up the issue until 1984. Ultimately, it took 4 years and numerous iterations to finally complete a deal. Given that there's bipartisan support this time around, it probably won't take 4 years to get a deal done, but whether it happens before year-end remains to be seen. A second key point is to realize that stocks may have already discounted the tax news. It's hard to know what's discounted and what's not. People don't fill out exit polls after they buy or sell securities. Let's just keep it simple and focus on 2 questions. First, how much would earnings go up with lower taxes? Based on the current 35% max tax rate, if we assume it drops down to 20%, which is the House's proposed, that would probably increase earnings per share for the S&P 500 around 6.7% over the next year. The second question is, how much has the stock market already discounted this news? If you pull up a stock chart of the S&P 500 since Election Day, you'll see that it's rallied about 12%, almost in a straight line. This figure exceeds the near-term earnings accretion to the S&P 500 from lower taxes. In the last 60 years, there have been 4 major tax cuts. Stocks rallied each time, about 6% before the policy was implemented and about 6% after. So the 12% move that we've seen already may have discounted the news. The third major takeaway has to do with interest deductions. The Republican blueprint for tax reform calls for eliminating corporate interest deductions. Think of this as the tax break that companies get on the cost of borrowed money, sort of like the deduction that homeowners get for mortgage insurance. If that goes away, highly indebted companies could definitely be disadvantaged. Last, if Trump really wants the economy to accelerate to 3% real GDP growth, companies are going to need to invest more. Lacking in the memo last week was any mention of immediate expensing for business CapEx. That's really important, because if there is tax reform, whether it's repatriation of overseas cash being stored to avoid taxes, or it's just lower corporate tax rate, the whole key is for businesses to use that cash to reinvest in the American economy, not to just pay higher dividends or do more stock buybacks. In closing, remember that Wall Street is comprised of millions of individual people making decisions to buy or sell in a given day, and they do so for different reasons. People can sometimes become myopically focused on narrow political issues, forgetting there are many factors outside of politics which drive security pricing. Thanks for watching this video. Please feel free to visit our website or call anytime to discuss this topic or other matters.